So, we've talked a lot about risk, and look, all the things that are concerning, that I've been concerned with for a long time, are still concerning to me. So, stocks are expensive, assets in general are expensive. So, fixed income, credit spreads, things like that, general hard assets, they're all expensive. That said, the irony is that I was probably more defensive about this 6 months ago than I am today, and the reason I'd say that is because there's nothing in my sort of foresight in the short term that would say that we're not going to continue on this trend for a short period of time. And when I say short, I think 2018 is going to be a good year for equity markets, for general markets and broadly. But I do think that we're all the things that we're concerned about are going to play themselves out into the tail end of 2018 to 2019. And so what do I mean by that? I think we'll have a good continued move into the equity markets. It'll probably be a positive, maybe even a double-digit market for equities in 2018. But 2019, I think we're going to start to see the real risks of overvaluation, interest rates, inflation, central bank movements, all that start to play into a potential for recessionary type of environment. And I think that as equity investors, that will likely be quite difficult, and we would likely see more negative environments. But the party's still on this year. That's the way I sort of look at it. When I look at credit, I think credit spreads, we know investor protections have gotten weak. We know that credit spreads are tighter than they've been in decades. And in my opinion, that investors are just not being rewarded. That said, defaults are low. There's no reason why we're going to see anything of change. But, as we move into the end of 2018 and 2019, I think investors should be extremely cautious about their exposure to high credit or risk. And then we get into interest rates and bonds. I think what, we all know is happening is central banks are slowly raising rates. There's nothing to say that they're going to not be as aggressive as they are. So whether the U.S. Fed raises rates this year and bonds get more expensive, bonds are expensive, but interest rates go up. What I actually expect to see happen is that, we'll see a flattening of the yield curve, not a meaningful move on long-term bonds. And so for most bond investors, even though they're very, very risky, in my opinion, from a risk-reward perspective, you're likely not going to have a bad year this year. You might be a flat to slightly negative, and I would be actually taking advantage of any strength in the bond market to be a seller as opposed to a buyer through 2018.